Hey, welcome to the live stream. Welcome to the live stream. We are coming at you on a day off on Wall Street. We have no trading occurred today, but we will resume trading tomorrow. It's been a year where we've had some sectors and industries really sell off. Software applications, Microsoft have really sold off. This space is under threat that, hey, AI is going to really take away some of their competitive advantages and make them more more vulnerable to its competitors. And we'll see if that actually happens. We'll have to let that play itself out. But really good businesses like Palantir down 26% year to date. Year to date means a month and a half, not that long. Amazon's been giving up some of their market cap, 13.88%. And I think the market does not like that they're spending so much in that data center. And they're trying to grow that part of their business. It's a good part of their business. And market doesn't like it. But other big businesses that are really well known, like Visa, MasterCard, also sold off. The banks have sold off year to date as well. For a while, they were doing quite well. So I'm not sure what's going on there. Apple's given up some of its gains that it's had. I know that I think on Friday, it had a real bad day. Maybe we can take a look at Apple a little later on this live stream. But if we go to smaller sectors like industrials, they've done really well year to date. Caterpillar's up a lot. Lockheed Martin up a lot, 34%. Consumer staples have done well year to date. Got Walmart up 20%, Costco up 18%. So that space is looking pretty good. Energy's done well thanks to higher oil prices. Materials have done great. Silver's just been on fire. So many gains there. Big pharma is beginning to show itself. Real nice gains by J&J, Merck, Amgen, Pfizer. So that looks pretty good. Biotech's looking good. So there's some spaces in the market that are doing quite well. Home Depot's up. Very good. And the trick is buying the right, stocks that are going to do well. One thing I'll report is some stocks look real well priced at a discount. Really good opportunity to buy into businesses that I want to own for a long time at a really good price. I'm finding more and more companies that are priced really well. So that's the good news. And if I'm a long-term investor, so with that type of long-term mission, finding stocks at a discount it's just become more accessible, and I'm glad to see it. Glad to invest. I've been buying into a lot of shares. So on this live stream, in case you're new, you could request a stock if you're a member, a paid member of the channel. That's one of the perks that you get to come to these live streams. You ask for a stock. I take a look at it from a fundamental perspective, looking at, is that business have really strong moats, barriers against competition entering their market? Do they make a lot of money in the form of high margins? Do they produce cash flow? We'll value the stock, comparing the value of its cash flows, the value of its profits versus the current stock price to see if we're dealing with a discounted stock. What kind of stock is it? Is it a real good long-term hold, or is it potentially just a short-term opportunity? Those are all things that as a long-term investor, I consider, and I'll share my research with you. So again, if you're a member and you want to look at a stock, put it in the chat. We'll take a look at it. If you're not a member, you can pay $5 and I'll take a look at a stock of your choice, or become a member on the fly. Very easy to do so. I think it's worth it. So take a look at the member program. It's on the homepage of my YouTube channel. I also put in the chat a link that can get you there. So looking at the earnings calendar, it is a day off here in the United States, but the folks down in Australia, where BHP is headquartered, they're working today. They're so ahead of us that their workday's already over, but they were working today. So Looks like USA, BND. Thank you. Thanks for joining. So we're going to take a look at BHP. This is a materials company. They produce mostly the ore that goes into steel production. They're headquartered in and around Asia, so they can distribute into Asia. Big consumer of steel. Looks like Sonoco also announced. That's a small cap, so I'm not going to take a look at that one. So that one will be a good stock to get started on. I'm interested in BHP. It's a stock that I've known of for 5 years, maybe longer. So we'll take a look at that one. Well, let's take a look at Zim. I heard through the Discord for this channel that Zim was being acquired. But when I looked at the stock, there wasn't any big jump in the stock price. So I wasn't quite sure what's going on. And I see that there may be shipping giant Hapag-Lloyd agreed to buy Zim Integrated for $4.2 billion. So where's the premium? How come the stock price isn't going up in after hours is my question. And maybe it'll start rising tomorrow morning. But that was a surprise. All right, let's get rolling with BHP. Talk about a company, talk about a stock. That's what I want to talk about. And as we go through here, if you're a new investor, I'm glad that you're, taking on learning how to invest in stocks. The way that I invest in stocks, that try to do my homework on a stock, understand it, understand how it makes money. Does it have competitive advantages, which keep its competitors away? How profitable is it? You can look at different businesses and they are very different in the amount of money they get to make for every dollar they sell. So that's a very big difference. The most valuable stocks on the stock market tend to have high margins, high rates of profitability, high rates of cash flow. And then I value them. The time value of money, one of the lessons of finance. That's really important to get your head around. I'm sure most of you have a good understanding of that. And that's what we're doing when we look at my valuation tools is we are discounting the future projections of those companies to today's value. So we'll get started with BHP. This is a large cap. It's a $180 billion market cap. It has a PE ratio of 14 for 2026. Dividend pays a nice dividend, almost 3%. Analysts think it's gotten a little expensive. Reason for that, it's gone up 44.85. The materials space has really done well in 2025 and into 2026. Material stocks are really, really doing well. These are cyclical stocks, meaning they go up for a while, they go down for a while, and it looks like we're going up for a while. This stock has really seen volatility. You got to get in and get out when it comes to BHP. If you bought way back here, you would have taken the ride up. We're kind of dealing with a little bit of a peak now. So I don't know if it's a great time to jump in. But let's see what they had to announce. According to Stock Analysis, they should have announced their earnings. Let's take a look at their website. And I know BHP is down in Australia. They announce twice a year, every 6 months, as opposed to here in the US, companies announce 4 times a year. So this is BT's financial results for the half ended. It looks like they may, yeah. Okay, so February 17th, that is us. All right, let's take a look at this earnings announcement. I wish it would have put it over to this side. All right. Make this bigger so you guys could see it a little easier. And I'll get my marker ready. So these guys, operational excellence, strong margins, cash flows, growth. Okay. So their EBITDA, their earnings went up. So revenue is up 11%. That's very good for a materials company. And part of it must be that the commodity price has gone up. Looks like Ben Tim is with us. INTR. It's on the list, Ben. Good to see you. Thanks for joining. All right. So profit up 28%. That'll work. That'll work quite nicely. So they're making more money. They're selling more and their cash flows are going up. Cash from operations really went up. They only had to put 1% more into capital expense. So there's going to be a lot more free cash flow. That is very good. So for the full year, we're dealing with $2.9 billion of free cash. That is real good. I'm going to note that. 2.9 bill of free cash flow. I have a valuation on BHP. We're going to update that together. I'll go through it step by step. So overall, just high level, right? Very good news. Revenue is going up. Cash flow is going up. Revenue is going up. Profitability is going up. That's great. That's why the stock's up 45%. It's fundamentally, I could explain why the stock is going up. It's all rational. It all makes sense. All right. So the payout ratio on the dividend is only 60%. That's solid for those income investors. Looks good. Return on capital, 23.6. That's a very good return on capital, on equity, excuse me. So economic outlook. So this is going to be pretty long. So these guys produce copper. Copper prices most definitely are going up. Copper's in high demand. I like that about BHP. I don't own BHP stock at this time. I've owned it in the past. I've owned it recently in the last 12 months. I owned it, wrote it up a bit, sold it, and I'm not currently in BHP. All right, so that looks good. The earnings overall have been good. What's going on with the stock? So looks like the stock in after hours, because we're not trading today, so we're not seeing anything happen with the stock in after hours. Pretty flat. So I'll take a look at, let's see. It hasn't been updated on stock analysis. Stock analysis doesn't update on international stocks all that well. US stocks, it does a great job. All right, so I could work around that. No big deal. Let's take a look at the valuation for BHP. All right, so here is BHP. The update that I have is fairly recent. I looked at the stock in December. So about 2 months ago is when I last looked at it. Okay, so I'm going with the average they've had over the last 7.5 years. And I'm going to keep to that because commodities go up and down. And with the material stock, I did the right thing because I ended up buying this stock 9 months ago or so, and I did well with the stock. Now, if I use the average and you see that the commodity prices have been going up, these guys will do really well in these times. And over time, I think that's what's going to be the case more often. I'm going to change my growth rate to 4% because we are kind of hitting a peak. And when we look at the equity value of the stock, what I'm doing is this is the cash forecast that I expect from the business based on their 7.5-year average. And it's discounted by 13% if I compare the current value of their shares and compare it to the current stock price. The discount rate I'm using, it's an international stock, so I'm using a higher discount rate than typical, and that'd be the case because it's out of my home country and I'm taking a higher risk. Okay, so one thing I wanted to check, and I'm going to do that on the screen you guys can't see. So I wanted to check some of these numbers, see if they've changed. So the market cap should be 180. And with these international stocks, the market caps and the share counts, they get confusing. So I have to go and manually put these in. It looks like the shares outstanding is okay. All right. All right, so that looks good. Now let me look at earnings per share, and I'm going to look that up on their earnings announcement. So I guess they're calling it something different. So let's try to find that. So here is their earnings. So that seems high. So what am I missing here? It's for the first half. Bear with me. I just want to make sure I use the right earnings per share. The earnings per share is 178. Okay. So right now, I think the BHP stock has run up quite a bit. So it wouldn't be a stock that I'd be all that interested in. Again, I bought the stock when it was priced much lower, took it for a ride upward, and I am out of the stock now. So with material stocks, you got to get in and you got to get out at the right time. If you stay in a material stock, you're going to see, like we're experiencing right now, a real nice run up, but you could also see the stock come down. If you look at the BHP stock over the last 5 years, this thing has been volatile for sure. And it was really on a downward, trajectory, and then it really ran up. So where's it going to go from here? I would venture to guess that it's probably going to give up some of those gains. Over the 1 year, it's up 45%. So I'll stay out of BHP. All right. Looks like a lot of people have joined. Thanks for joining. Good to see all of you. We're going to look at INTR next. Looks like Zubio is in. If you want me to look at a stock, glad to. Just buy a $5 super chat on that or become a member. Marcus, Jeff, good to see you guys. Thanks for joining. All right, so INTR, what are we dealing with there? What is that stock? So Inter and Company, through its subsidiaries, engages in the banking and spending, investments, insurance brokerage, inter-shop businesses in Brazil and in the United States. The company offers banking products and services, including checking accounts, cards, deposits, loans, advances, and other services, as well as debt collection, foreign exchange, financial services. So we're dealing with a company in Brazil, and Brazil's actually a country that I am interested in. It's a big country. They have a lot of people. Their economy does well. They have a lot of natural resources. Let me see if I can get this to change to English. Well, I guess we're going to do this in Portuguese. We'll just go through images here. So these guys are doing a new form of banking. The other business that's out there in Brazil is New Holdings, and I'm familiar with New. Okay. Very good. Okay. And I haven't worked with this stock yet, and it looks like they may not have an English version of it, but let's see. Nope. Guess not. No worries. We'll look at their fundamentals. That should be easy to translate. Hey, looks like Sergio's on. There's a name going back, geez, over a year. Good to see you, Sergio. Thanks for the offer to translate in Portuguese. Thank you, sir. All right, so this is a small cap, 3.85 billion. It's up 66.9% over the 1 year, I believe. So real nice run up in this stock. Look at that chart. This is a good looking chart. It's gone up 119% over the 5 year. Looks good. Revenue, 1.06 billion. Okay. Forward P looks really low at 10.7. And analysts think it's gotten expensive. It has been going up, but it could continue to go higher. For the last, let's call it, I guess I'm going to say about 5-6 months, it hasn't gone much higher. It's tried to go higher, but it's kind of gone up, come down. It's kind of consolidated around, this $8.50 a share range. All right. So these guys, let's see here. So they're doing a lot of banking services, and it looks like they're being treated as a banking institution. And you want to look at net interest margin. The way I look at banks is I look at earnings per share. I want to also look at the book value of the business and their price to book. Like big banks in the US right now have about 1.7 ratio if you compare their price to their book value per share. You want it as low as possible. So if you had a bank that is a very good bank at like 1, that'd be a very good buy. It'd be discounted. If you had a bank at like 3, that means, wow, it's kind of an expensive stock. So let's take a look. We're going to look at earnings per share and book value. So these guys, okay, they're trying to make interest income. It looks like they're making plenty of it because interest income on loans, on investments, they pay this amount on deposits, so they get to keep 5.7 billion of that overall interest. So the differential is really advantageous for this business. Looks good. Looks like Ben 10 is saying that they own a stadium in Orlando, Florida. Okay. All right. So earnings per share has been growing. That looks really good. And we're going to look at their book value on the balance sheet. Book value is all your assets minus all your liabilities. And that is their book value. It's been going up. It really went up from 21 to 22. And from there, it's been going up. Nice, steady rise. That looks really good. Okay. All right. And I'm going to look at the statistics here. It'll give me my price to book ratio. It's right here. PB ratio 2.12. And again, big banks are at 1.7. If you're smaller than a big bank, you should have a more attractive ratio, which is a lower ratio. So this ratio isn't all that attractive. The stock's been going up. It's getting a little expensive maybe. 2.12 is not a real attractive price to book ratio. It's an okay ratio. If you think they're going to continue to drive growth, it might be fine. Like if you look at SoFi, I think it's got a higher ratio. So let's take a look at the forecast. We have 3 analysts. They think it's priced a little too high. We do have a forecast on their business. Their revenue is expected to grow nicely in 2026 by 25%, 18%, then 23%. It looks good. Very good growth. Earnings per share is really going to go up, bringing down their their P ratio to 10.8 this year and then 8.5. So this is more attractive than if you looked at like some US based banks or finance companies. They probably have P ratios between 14 and 18. So this does look advantageous, but the price to book, not so much. So this one here, it's not an obvious like, wow, that's a really good opportunity. I do like the revenue. The revenue growth looks really good. And I wonder how these guys stack up against new holdings. Let's take a look at that. All right, so going through the same process, new holdings is similar, right? Digital banking, Brazil, maybe they're in more countries, Mexico, Colombia, the Cayman Islands, in the US. And I think the new holdings is going to try to introduce more products here in the US. So that'll be interesting to see if they pull that off. This stock is up nicely over the 1 year. It's not up as much as INTR. Over the 5 year, it's not doing as well as that either. It's a bigger cap, 81.5 billion. So it's a better known company, better known stock. Forward P is much higher, 21. INTR had a much better PE ratio. And analysts think there is a small discount here available. So let's take a look at their overall earnings per share. Has been going up, not as dynamically as INTR, and their price to book. So their book value is going up nicely. That's a real nice growth to the book value. So the earnings per share for new holdings looks expensive next to INTR, but let's see what the price to book looks like. Price to book ratio is really expensive, 7.7. So new holdings is looking really expensive. So INTR would be a better buy than new holdings. Both, I don't have a full comfort level in Brazil. It's just an economy that I have very little knowledge around. It's not in my circle of competence. I'd like to become more informed. And for me, it seems like INTR is a good opportunity. The growth is really good on top line revenue. And that always says a lot about a business. If you're growing your top line revenue, that means the business is getting more customers, doing more revenue. All those things are good. And INTR has a license with the US. That's good. Yeah. So they can do business here. That's a good idea. I think INTR looks from a top line revenue perspective, I think it's a good idea. So we have, all right, let's do a quick valuation. I'll put it next to NU and then we'll see where we value the stock. Okay, so all right, so I'm going to take a look at a model that I could reuse, and then we'll update all these calculations with the information from INTR. So this is a smaller stock. I don't know them as well, so I'm going to go with a 9% discount rate. And let's take a look at their market cap. I think that's going to calculate. See if that's correct. See, the shares outstanding are not matching because these international stocks, the lookups, they don't work all that perfectly. So I'm going to look at that in a little bit. So earnings per share for 2026 is expected to be 422 in the Brazilian currency, and BRL, so it's 0.19. Okay. So if we put in 422, so 80 cents a share. P ratio, I'm going to go with 18. It's growing that earnings per share nicely, but that might be a little too optimistic. So yeah, you can get to a valuation that shows that this stock can continue to go higher. It's discounted by 49% based on earnings per share. The price to book was a little expensive. Let's take a look at that. So this is the average is 170. The book value for the company is let's see here. Book value is so fully diluted shares. Let me get that. So that isn't correct. So let me get the correct number. That is correct. Okay, good. Looks good because the price to book is lower than 170. So this looks really good. If you're comfortable with this business, this looks like a well-priced stock on a company that's growing really fast. So I like everything I'm seeing there. And you know, the US stocks are getting better priced for sure. But I know that stocks in other countries in 2025, they're priced far better. Like China, I did really well with my Chinese stocks. I don't own a lot in Latin America, but I did well with my material stock down in Latin America. And so it's not a bad idea to, diversify around the world. All right, let me add this to the watch list. If you're a paid member, you get access to this watch list and you're able to take a look at all these valuations. I like updating kind of like the listing of all these stocks. Before I do that, let me make sure I don't have it already. I don't think I do. Nope, just once. All right, and that's INTR and Company. All right, I'm going to put it on a category of watch, maybe buy it in the future. I'm not ready to jump in just yet. I'd like to do my homework on it. I like that it's small. I like that they're doing well. And I wouldn't mind learning more about Brazil. It's a big economy. There's a lot of people there that want banking services, and it's not a bad idea at all. All right, we'll update. All these fields of fair price is over in our intrinsic value. If you're a member, you get access to all this research. So keep in mind if you'd like to become a member. So all right, so that's available to investors now. We have close to 400 valuations that are available to paid members. You have to be an advanced member. It's not just a base membership or a super investor, but you have access to over 374 valuations, actually 376 to be exact. So if you're considering being a member, that's one of the perks you get as an advanced member. All right, Ben 10, that was a good one. Thanks for bringing that up. That looked pretty interesting to me. All right, it looks like Peter is on. Good to see you, Peter. I hope you're doing well. SRAD. I'm not familiar with them. Let me check in on the chat, see if there's any questions that I missed. Nope. So yeah, that's it. That's a good looking stock. It's just and it's been working too, which is there's a couple things that look really good. Is the stock's been working long term and short term. The valuation is there. It's in an economy that continues to grow. I think Brazil, especially for financial services, it's a big addressable market. And I think these guys will have plenty of market space to grow. So that looks really good. Looks like Herdo is joined. Good to see you, Herdo. Good to see you, sir. All right, so let's keep rolling. We're going to go to SRAD. So SRAD is Sport Trader Group or Trader, Sport Trader or Sport Radar Group. Together with its subs, provides sports data services for the sports betting and media industries in Switzerland, the US, North America, Africa, Asia Pacific, Middle East, Europe, Latin America. Interesting. So these guys, so if you're planning on betting on basketball, boxing, or this is MMA, these guys, I guess, will get you some data that'll help you do your homework if you do any as you bet. I mean, the World Cup's coming, right? So that's going to be exciting. All right. So that's what they do. They remind me of what's that stock? Gambling.com. And let me open that up to give you an example. Gambling.com is highly discounted. And this space here has just been destroyed. Look at this, down 70%. And this is a company that is growing revenues. Okay. And if you look at their forecasts, it's expected they're going to continue to grow. So you're like, what gives? The company's growing top line, it makes money. It's not taking bets. It doesn't do gambling. It provides data to the gambler. And looks like John Rogers for a super chat. You got it. Sprouts Farmers Market. You got it. It'll be our next stock. And then Herdo, I'm going to look at ALK. Take a look at that. So let's carry on with SRAD. This is a gambling information company. Of course, big news is the gambling sites were established like what is it? I forgot something Kings. Forgot the first name of it. Now, the prediction markets companies like Kalshi and Polymarket have come in and kind of disrupted that whole space. And I think the market is like, well, who else is going to be disrupted? Is AI going to take away all this revenue from gambling? To kind of just set the environment of this industry is why I wanted to show gambling. So Sport Trader or Raider, that's what they do. They're in that space. The 1 year, they're also getting beat up. 5 year, look at that. They came back. Now they're being beat up again. So their market cap, almost 5 billion. They have kind of a high PE ratio, 35. That looks a little expensive. Analysts think it's priced really, really discounted. They have been growing. They're pretty good size, 1.2 billion. The quarterly looks good. 14.45% growth is good. It's not incredible. I mean, they're small enough to, like, there's some stocks that are this small. They're growing really fast. And their profit isn't all that great. When we look at the gross margin is 25%. Why is it so low? They're selling data. Why is it so low? And free cash flow margin is good, 31. And when we look at, a comparable company, gambling.com, gross margin 93%. They're selling information, data, right? And then the free cash flow margin is good. So that was a little bit of a surprise that, well, what are you guys spending your money on? Let's take a look. Well, first off, maybe they're buying the data and then providing it to that customer, and they're paying something for the data. And that's what's driving up the cost of revenue. That might be it. Okay. So, okay. Forecast. 17 analysts saying that, hey, this is really discounted. Okay. They're going to keep growing. And revenue is going to look good. This year, they're going to expand their profits by 23.8%, then 54.4%. Their PE ratio is going to come down to 18. So their free cash flow, $464 million. That's really good. Okay. So I'm going to value this stock. We're going to get to some numbers. And I'll give you my conclusion later. Okay, so SRAD. And we will put these guys next to gambling.com. And in addition to Kalshi and Polymarket being online, there's other companies that are jumping in the whole prediction markets, gambling. One of them, Robinhood, they're all over it. They're trying to get into this business and get a piece of the overall market. They've been fairly successful in doing so. And the other company is Coinbase. I listened to the Coinbase earnings, and I've read their earnings as well, and they're getting into the prediction market. So as we look at the World Cup, there's going to be multiple places where the gamblers that want to put a bet on a World Cup, they can go to DraftKings or somewhere where you would traditionally go, or you can go to Kalshi, Polymarket, Coinbase, Robinhood, and that's why there's pressure on these stocks. Is if there's going to be more competitors, and some of these competitors are really good. You got Robinhood's doing great. They got really good uh, customer base. The customer base likes the brand, and rate. What happened there? Okay, so we got that there. Now, I don't know these guys all that well. Gambling, I'm using a discount rate of 10%. Let me hold off on that for a little bit. So trailing 12 months, these guys were growing nicely. I'm going to grow their free cash flow by 12% and then 4% in the terminal. They had free cash flows of 464. Okay, so let's take a look at their balance sheet. We've got $422 million of cash and $73 million of debt. Good balance sheet. And the shares outstanding, so 52% discount on cash, and that's at a very high discount rate. I'm going to leave it there, and I'll explain later. Forecast. So they're going to be growing this year 22%, 15, 14. So that looks really good. I'm going to leave it at 12. So overall discount of 42%. Why am I giving them kind of a pretty low PE ratio? Is because of the threats around their market. You got Kalshi, Polymarket, Coinbase, Robinhood. You got all these newcomers that are trying to grab a piece of this market. And you have AI. If these guys are providing information, AI is doing a great job. Like Gemini, OpenAI, all these AI agents really get you good data. So if you're a gambler and you're like, hey, I have to pay for this data, I'd rather just go to an AI agent and get that data. It may be a little better, a little worse, but if you're using Gemini all day long, why would you abandon Gemini and then go use Sport Trader or gambling.com? So this one here, I wouldn't invest in it because I think there's a lot to be determined there. Gambling has just been destroyed by the market. The market doesn't care that they keep growing and making money. It's like, hey, the market believes this space is going to be disrupted. And looking at where the stock is trading, the market's beginning to feel that way, or it's been there since August. So since August, it's been sold off. When is it going to start to go higher? That's a difficult decision. I think the market's really, it's really nervous that this space is just going to get really destroyed downsized. Some of these players are going to be really a shell of themselves like in 3, 4 years. Some of it may be true. And I don't know how much of it is. But for me, I'm just going to stay out of the space. There's some weird, I wouldn't call it weird, just reality, right? Like software stocks are getting really sold off. The whole AI threat. I don't know what this is about, but it's pretty meaningful. And that's where I'm at with that stock. It would be a complete pass, not because they're not valuable. It's because it may be 6 months, 16 months, 3 years before you start seeing this space move higher. I don't want to be part of that. I'd rather wait for it to start to show that it's going higher. Then I might be interested. So far, Sport Trader and gambling.com are showing that, hey, the market doesn't want those stocks. Okay, I'm going to hold off from investing for a while. All right, let me add that one to the watch list. I know Peter's a member, so he could take a look at my numbers. All right, so I'm going to put this guy next to gambling. There's DraftKings. Yeah, I could put it next to DraftKings. And let me double check if I put it in the right one. These guys are in Switzerland. And the industry they're put into is software technology. I don't know that I agree with that. But I'll go with what's listed. So these guys are a watch stock. I have to see that the market is going to buy into these, or maybe we start seeing that the businesses start getting disrupted. And I'm going to say Europe, even though Switzerland is not part of the EU. I think from a continent perspective, they're part of Europe. All right, fair price. All right, so man, we just keep adding stocks to the research sheet. And now you've got access to it. All right, let's get back to the list. Good to see you, Peter. So let's get into Sprouts. And I agree with you that Intuit is a great buy. Intuit is Ricardo. Good to see you, Ricardo. All right, let me check my list here because I want to make sure I cover the right stocks. So we're on Sprouts Farmers Market. We're going to do ALK, and then we're going to look at Intuit. So let's take a look at Sprouts Farmers Market. Now, this stock I've observed for a little while because it really went up. This is a grocery retailer, okay? Now, when I look at a grocery retailer, I'm not overly excited. It's supposed to be a consumer staple stock. And if we look at where these guys are paired up, consumer staple. And Sprouts, in a lot of ways, it reminds me of Trader Joe's. If you guys have Trader Joe's where you're at, the footprint of the stores is smaller. It's not like a giant, Costco or a big Kroger. They have a smaller footprint. They tend to sell things in a lot of ways, some things that are pretty close to ready to eat. You can warm it up and so forth. I like their catalog. I think the catalog is good. A lot of healthy options. Now, the stock is under a lot of pressure. What happened? For a while, the market really liked the growth. It was better growth than what Kroger and others were having. Now, what's interesting is you see the trailing 12 months growth is still very good. But I think the same store sales number is where they are taking a hit. And part of their growth is that you have, when it comes to retail, if you keep the same number of stores, but you're doing more revenue, that's the best case. Like, wow, that's great. That means customers really like your product. They're paying higher prices. You're getting more customers through the door. You're not having to invest a lot of capital to grow. If you're growing your store count, it's good that you're growing, but it's not as good as that organic growth, keeping the same store sales at the same amount. Let's see if we're going to have, I don't think we have same store sales there, but we're going to look at it in a little bit. Okay, so the growth is there. And before I move off of that, let's see, ratios, PE. Sometimes stock analysis has it. Looks like they don't. So let's open up Gemini and ask. So I'm asking Gemini what the growth in store count is. And Sprouts Farmers Market is currently executing an aggressive expansion strategy, shifting from historical growth rate of 5.7 to 10%. Unit growth. Oh, wow. Okay. So they're going to be growing their units. Nicely done, Gemini. So in 23, they had 407, it went to 440, 477, 515. So this is potentially very good, but this is grocery. Remember that. So it looks like they're growing by adding stores. Now let me ask. What is the same store sales for Sprouts? So 5.9 in Q3, Q2 10.2, Q1 was around 10.5. These numbers look good. You can see that there's kind of a deceleration going down to 5.7. And that might be what is hurting the stock is investors are nervous that, hey, you guys look good when, you could just look at the income statement to see that growth, but you're doing it through adding stores, which gets expensive. We're going to look at their debt in a little bit. Okay, so they're down quite a bit. The market cap is down quite a bit. Let's take a look at a couple more things before we jump in deep on the financials. So the P ratio looks good, 12.5. Analysts think it's highly discounted. I already covered that the stock's under a lot of pressure. Okay, so we're dealing with a company that has a lower profit margin. It's better than, let's say, a Kroger, but it's 39% gross margins, profit margins of 6%. That's also good, by the way. That's good compared to other grocery stores. And that looks pretty good. The free cash flow, 457 is their free cash flow. All right. I wanted to look at their debt. Let's see where that's going. Long-term debt. They didn't have it. Now they don't have much of it. So the leases I get, I was expecting debt to be higher. It's not very high. Okay, so forecast. 13 analysts cover them, big discount. Growth is going to persist. That looks good. Earnings per share. These numbers look good. They look pretty darn good. And we're dealing with a consumer staple, right? It's not like people are going to go to Sprouts if they like the food there. If you're buying food at a grocery store and cooking at home, you're probably saving yourself some money. You're probably eating healthier. This stock's discounted by 43%. I've looked at this stock. I own Kroger. I have looked at this stock potentially to invest in it, but I'm waiting for the market to show me when the market's going to start buying the stock. And it's not looking good. It's the market's just not buying into it. They're going to announce earnings this week on Thursday. Maybe that'll change things up. If they announce really good earnings, that'd be a good buy. One last thought on this. How much lower can it go? I don't think it can go much lower. So I don't know the risk is all that high. I think it can't go much further down. This is a consumer staple. They're growing. They have a good business model. And you could be sitting on a nice, 25, 35% gain over the next 12 months. If it takes a while to go higher, this is all assuming they keep doing well, right? It might go down another 5%, 10%, but not much more because it's already down so much. So for me, Sprouts would be a buy. It looks good. It's in the right category too, by the way. So I'm going to upgrade that on my list here. So Sprouts Farmers Market, I'm going to upgrade that. I'm going to put it. I think it looks really good. It's a good idea right now. Considering that, technology is risky right now. The market's kind of afraid of anything or stocks that are going to be impacted by AI. And my staple stocks have been doing well. I own 3. I own biggest positions Kroger. I really like Kroger. Steady as she goes. I've made good money. I buy at the right times. I own Colgate Palmolive. Been doing well with that stock. I own Target, and that's a company that I think is going to do really well. I'm up on the stock. It's a boring stock. The money spends the same. I make money on Target or I make money on Google Alphabet. The money spends the same. So I really like Sprouts. I think it's a good stock. I've been looking at it for some time. So thanks for asking, John Rogers. Reminds me of Sprouts. I'm going to take a look at it. Maybe I could buy it this week. Why do I have that as Australian? That is not Australian. It's US. All right, sir. Thanks for asking. We're going to move on to Intuit. I'm sorry. We're going to move on. No, ALK. So ALK. Oh, Alaska Air. Whew. Airlines. Airlines are risky. They've been doing well. I owned United. I think it's UAL. Yeah. So it was a successful investment, but man, I left a lot of money on the table. So I thought, okay, everybody's crazy thinking these airlines are going to go bankrupt. And I bought this stock at good prices. I saw the stock go up maybe to this level, and I took a nice gain, measured gain, and the stock's gone even higher. So that one was a little painful. That doesn't really tell the story because you could have bought the stock at like $35 a share and you're sitting at 109. So you could have tripled your money. So this one here, I was a little afraid that, that's as good as it's going to get. It's the airline business. You don't want to stay too long in that type of business, but United has been just doing really well. Alaska is a good airline. Alaska's more, It's smaller than United, smaller than American. Southwest has been having really good numbers. These guys announced on January 22nd, so the information's relatively fresh. The stock's under pressure. PE is really low. Analysts think it's discounted. They don't pay a dividend. They've been growing. Look at that, 21%. That looks good. And let's take a look at the quarterly. Oh, okay, here's the problem. Didn't grow in the quarter. So the market was really upset with that. Why aren't they? So the airlines have full airplanes. Right now they're raising their ticket prices. They have airplanes that are full in their capacity. Why isn't Alaska participating in that good economy for the airlines? That's a big question for Alaska Air. The airline business is a rough one. Look at the cash. No cash. No free cash flow. Margins are tight and very asset capital intensive. You have to buy these really expensive aircraft. You have to buy a lot of equipment to operate the airline safely. So this is traditionally not a business I want to touch. I'll be opportunistic here or then. But right now, I think we're dealing with stocks that are priced probably at the best that we're going to see them, like United Airlines. Is Alaska going to be a comeback story? Could be. 11 analysts, they think there is a 28% discount. They're supposed to grow in 2026. We saw that bad quarter here. The quarter that they're going to announce, it's expected they're going to grow at 6% and then pick up the pace. That does look good. Their profitability is going to come back. Boy, is it going to come back. These numbers look really good. Alaska can bounce back. Look at the P ratio. If the stock price stays the same, it's going to be a 6.5 PE ratio. Really low. This is an opportunity to swing trade, opportunity to pick up a stock that's really, really discounted. And other airline stocks have been doing really well. United Air, Southwest, I think, has been doing really well. They don't have free cash flow, so I can't give you a free cash flow valuation on this one. I don't think I have it on my sheet here. Nope. I have United. I thought I had United Airlines. Guess I don't. I guess I deleted it because I didn't want the memory of me not staying in the stock long enough and making more money. Oh, man. So it's the airline business. I would not touch it. I don't think there's enough there. It could recover. It could be a really nice, stock that recovers. But what if we go into some type of recession, right? If we have some geopolitical tension and all of a sudden everybody's afraid and doesn't want to travel, Alaska, United, American, Southwest, all those stocks would be under pressure. So this would be a pass for me. There's no cash flow. The earnings are going to look better. The profitability is going to look a lot better. So good luck with that. Who asked about that? Herdo. Yeah, that's a beat up business. And, there's one, I guess my preference, I should disclose that, is if I spend a lot of time analyzing an airline or airlines and then investing in them, I'm consuming time that I should be spending with technology stocks, communication services, financial services, places where I can find my next, multi-bagger, my next real good stock. So in my book, I need to be aware of that not only am I investing my capital, I'm investing my focus, my opportunity cost. And I just don't want to spend a lot of time investing in airlines. So that's my point of view. That's how I invest. And it doesn't look like an obvious winner. I think they've had a bad quarter, and they're going to have to announce good earnings on their next earnings to pick things up. All right, so I think Ricardo wanted to look at Intuit. Let's take a look. Intuit is a software company and really has been successful for a long time. They're under pressure. The market believes that AI is going to make Intuit less needed, less of a necessity. I don't agree with that. I think that Intuit provides accounting software and other things like purchasing and so forth for small businesses. It does a great job doing that. It does software to prepare your taxes. We're in tax season. They do a great job doing that. It's been a really good business for a long time. And it's always been priced with a premium. It's been a really, really well held stock. Look at this. Historically, this was just a really prized stock because its business continues to grow year after year after year, just keep growing. And it has terrific margins. You see the gross margin, 80%. We were looking at a grocery store, 29% gross margins. The airline business, 20% gross margins. The software business, 80% gross margins. Now, the market believes that, well, with AI, this is going to change. I'm not sure about that. I don't believe that, but I could change my mind or my point of view if I see more evidence of that. For now, I'm seeing that these guys are holding their revenues. AI's been around for a couple of years, and their revenues are not fading. They're actually doing well. So Intuit continues to grow. They're going to announce their earnings on February 26th. So we are 10 days from that happening. It'll be next week, I guess on Wednesday or Thursday. And the forecast, let's take a peek at that. It's expected, and this is a lot of analysts, 36, 36, 22. 14.9% growth for the remainder of their fiscal year that ends July 31st, 12.5, 12.7, 13.8, 10.6. These are good growth numbers for a large business. This is big, 21 billion in revenue. So that's really, really good growth. And the profit continues to expand, bringing their PE ratio eventually to single digits. How is an 80% gross margin business going to be priced at a single digit PE? That's when the market is really afraid of a big causal factor changing an industry. Now, if the market's right, stock is priced right. The market's wrong. This is going to be a big winner for those that invest in it. I happen to think that the software space is going to do well in the AI space, in the AI era, because AI just helps them become less, have less cost and become more profitable. The brand Intuit is super valuable. People do their taxes. They want to trust the software they're using. You're putting in really sensitive data and you're doing your taxes and reporting it to the federal government, the IRS. Speaking for myself, I'm not going to leave that up to, oh, hey, here's a new little company that promises to do my taxes well. No, I'd rather just go with a very known brand, do my taxes, be done with it. So overall, Intuit is really well discounted. It's been sold off. I'm surprised it's been sold off so much. And the updates from Google are not working for me. Let's do a refresh. Sometimes those lookups are not working, but now they are. 51% discount on a historically excellent business. Intuit's a buy. I think the software space will be priced higher. I'm not buying into the software space, but I think the story that we're going to be hearing a year from now is, man, I can't believe the market was pricing the stocks that low. So I'm going to stay invested into it. I'm going to study their earnings that come out next week. I'll create a good video for members. So Ricardo, stay tuned. Next week, you'll see a good video on Intuit. I'll dissect their earnings and see what's going on with that really good company. All right, so we got these discounts on Intuit. Let's do this. Let me show you this new valuation tool that I've got going. I've got a new website going. It's going to be kind of like the hub of all things that I do, investing and sharing with people that want to look at my research. And I created these two apps, and these apps will value a stock like Intuit based on free cash flows. It reads the free cash flows from Yahoo Finance. And what is my growth rate that I was expecting on Intuit? Let me take a look. Open that up on another sheet. So I'm expecting 15% growth rate on cash. And I'm using 7. These guys have a terrific balance sheet. Really good balance sheet. Terminal growth of 4%. That is correct. So the app is saying it's highly discounted. I agree with that. So when I do it through a model, I get to a discounted stock. When I do it through the app, now I'm valuing the stock using earnings per share. And the growth rate on earnings per share that I'm using is 13%. The P/E ratio I expect in the future for Intuit is 25. And then the discount rate is 7.5. And when I look at the discount on earnings per share, it's not quite as high, 11.4%. But this is where the money is at for a long-term investor, is in the free cash flow. If you're interested in working with these tools, just go to my website, Rational Stocks. You'll become a paid member, but the first 30 days are free. So you wouldn't hurt my feelings if you tried it for a week or two. If it's not your cup of tea, you canceled, no big deal. Take a look. I welcome you to take a look at it. I've been testing this tool out, and it is relatively accurate in a lot of ways. Gives you good insight into a stock, giving you a very good grounded valuation method. This follows the strict finance calculations of valuing a stock based on the discounted free cash flows. It uses the historic data that's reported through Yahoo Finance on both the discounted free cash flow and earnings per share model. And take a look at the website in general. I've been adding some things. The base application, right? It follows my methodology for investing. You can see that on the very first page. And then I've got the contest information here. The best stock right now is ALM. We'll see if that holds the lead until the end of the quarter. Got a blog going. This is new. And I'm trying to publish at least one thing a day. Latest thing was why are Chinese stocks outperforming US stocks. So that's a video that I put out there today. I think yesterday was on Coinbase. Coinbase is doing great. And then once you go to valuation tools, this is where you have to get signed up. Again, first 30 days are free. And if you want to look at the company moat, same thing. You have to get signed up, but you can go through the methodology that I use to see how I get a stock kind of categorized. If it's a green stock, it's a good long-term hold, or is it a gray stock? It's investable, but you got to have a good plan around it, maybe invest for a while and then cash in. Red stocks, be careful. Red stocks are undesirable. and you might be able to pick one up, but I remind you that if I spend too much time dealing with red stocks, maybe I miss the next Robinhood, the next Palantir, and that's too high of a price for me to pay. So take a look at the website, and I appreciate you considering it. All right, guys. So looks like I got through the list. Yep, got through the list. And I don't think the markets are going to tell us much in the pre-market yet. We're supposed to open a little higher, but there's a lot of time between now and when we open tomorrow. We'll see where they open. Oil prices are going up a little bit. Crypto never closes. Ethereum is up a little bit. This really bounced back, by the way, and that's what caused a real good run up on Robinhood, Coinbase, and Strategy, that company that owns a big balance sheet of Bitcoin. So we'll see how things play out this week. In Asia, they are celebrating the Lunar New Year, so they were partially closed, for the most part closed. So not a lot of trading in Hong Kong. Europe should be trading today. Looks like in England, the stocks are higher. Germany, a little lower. France, even. And I'm not sure which one this one, Italy. I'm not sure. All right, guys. Well, thanks for tuning in. Appreciate you joining the live stream. I'll be streaming with Daryl on Wednesday morning, and I'll try to stream tomorrow evening. If you're around, I'll try to put the notice out when I can. I just need to see how busy I am tomorrow. And I'll put the notice out there. It'll be in the evening, like 4 p.m. Pacific start time. If you would like to tune in and ask about a few stocks, join me at that time. Everybody have a good night. Appreciate you joining.